Stock traders worry about Downturn, the sequel. The threats seem to be coming from all directions. Jittery stock traders react to each day's news as if it could be the start of financial crisis 2.0. On Thursday, the Standard & Poor's 500 index suffered its biggest one-day drop in more than 9 months because of worries about debt problems in Greece, Portugal, and Spain. More concerns about China's plans to limit economic growth and proposed regulatory bank changes from Washington also have pummeled the market. The fears aren't quite as intense as in 2008, when the S&P 500 fell 38.5%. But January was the worst month for the market since it began its recovery last March, and the S&P 500 has fallen 7.3% from the high of 1,150.23 it reached January 19th. It's not as if something devastating has happened yet, either in Europe, where economies have been struggling for some time, or in Washington. It was expected that the Obama administration would try to restrict big banks. What's different now is that investors have much more to lose than they did a year ago, so they sell at the first whiff of a problem. Even with its recent losses, the S&P 500 is still up 58% since hitting bottom March 9th. The key here is volatility. Investors are linking financial problems in Europe with the U.S. economic recovery. Some worry that government's debt problems will spread in the same way that bad mortgages in the U.S. took down economies here and abroad in 2008. And there are also many more foreclosures to come. They are shell-shocked because they've seen a similar movie before and they didn't like the ending, said Anthony Chan, chief economist at J.P. Morgan Private Wealth Management. They're wondering whether this is a sequel or not. Chan said investors are probably overreacting to the problems in Europe, but he said they are more demanding about what they want to see from the world's economies. The market is not going to be allayed by signs of recovery. They're going to be looking for signs of sustainability, Chan said. Fourth quarter earnings reports bear that out. Profits have come in stronger than expected, but still left stocks sputtering. Even a supporting hand from the Federal Reserve hasn't given the market any new oomph. The Dow Jones Industrial Average rose a modest 42 points on January 27th, after the Federal Reserve issued a more upbeat assessment of the economy and pledged to keep interest rates low. On Friday, the stock market drew little support from the government's surprise announcement that the nation's unemployment rate fell in January to 9.7% from 10%. Of course, it could be an aberration because they are calculating the unemployment rate differently now, in different ways. Investors also seemed unimpressed by two signs that the labor market is improving: increases in the number of hours worked and in the number of temporary workers hired. Instead, the market focused on the fact that employers cut 20,000 jobs in January. Economists had forecast that employers created 5,000 jobs. So again, if the U.S. economy is still losing jobs, there can be no real economic recovery. You can't keep losing jobs month after month no matter the number, and still have a real economic recovery. It's just not going to happen because consumers drive 3/4 of the economy. Economists have few expectations that the market will start rallying soon. Many are looking at a very difficult 2010. Chief market strategist at Execution LLC in New York predicts stocks will fall at least 11% from their January 19th high. That would constitute a market correction, which is generally defined as a drop of more than 10%. Until now, the biggest setback in the market's rebound had been a 7% slide from mid-June to mid-July. I think essentially, no matter what the market was going to come off at this point, we just stretched the rubber band too much, way too much. And again, this time it's different. There's never been days like these before. There'll never be days like these again. Unemployment is still high. 8.4 million jobs have been lost in this recession. And that's a lot of people out of work. If they're not spending, then, like I say, there can be no real economic recovery. Because this time is different. There's something much more going on here. Something much bigger. Because these are more signs of the end times. Transition days. A huge, great transition is going on all around the world. Everything that must change for the better. And it must change rapidly or quickly. Because there are many, many signs happening day by day.